Hi everyone, I know you're used to seeing my face all the time, but today I'm joined by my lovely wife Erica, who is technically retired by the way, thanks to our passive income investing strategy. That's why she's always happy and smiling, as you could see.
Right.
So I want to point out real quick that without her, there would not be a YouTube channel. I might be the face that you always see, but Erica handles basically everything else, like the back end, the editing, the description, social media, and of course, our brand new website, passiveincomeinvesting.ca. That's where you could get our first ever digital product that we're very proud of, the ultimate dividend passive income investing package. And that's also where you could book a one-on-one consultation with me. So I want to publicly thank her in front of everyone. I'm sure you would agree with me. So thank you. We appreciate it.
It's my pleasure. You're very welcome.
So our last video was definitely our most popular and most viewed video to date by a lot. We got many positive comments and thank yous, which we really appreciated. We just love the fact that this content is helping a lot of people, so it gives us the encouragement to keep going. So I want to reiterate that we own what we preach, and again, I feel very strongly about this. There is no right or wrong way of investing. We're just sharing with you our style and our strategy that we've developed, which works best for us. So our last video, don't forget, was really our main dividend portfolio, which includes our two TFSA accounts and our two cash accounts, which we use to pay off all our living expenses. But like I mentioned at the beginning of the video, it doesn't include our two RRSP accounts. So we'll go over my account first. I'll show you the holdings that I have as well as the income that I'm making, the average dividend yield, everything you need to know. But first, I just want to quickly discuss the strategy I used for my account specifically. So for my account, I decided a few things. Number one, focus on obtaining the maximum income I can while being as diversified as possible and really try to hit a 10% annual yield or more. Number two, hold many of our favorite US listed funds that have high income for the RRSP. Very important, guys. When I say US listed stocks, I mean stocks that are listed on a US exchange like the New York Stock Exchange or the NASDAQ. So why did I decide this? Well, it's simple and most of you already probably guessed. There's no 15% withholding tax on the dividends on US listed stocks if they're in an RRSP. This is only unique to the RRSP. So if you have US listed stocks or funds in a TFSA or a cash account, you automatically pay a 15% withholding tax on the dividends you get. If you want to know more about this 15% tax or you never heard of it, make sure to check out our latest tax video where I cover it in detail. And point number three, I don't use the drip. So the reason is simple. The drip is pretty much not even available for many of the US listed stocks. Why? I don't really know. It could be specific to our broker, TD. It could be because it's a Canadian broker. Who knows? So instead, I reinvest the dividends manually every month or every 2 months, which is basically kind of like a drip anyway. So as simple as that. So now let's check out the portfolio in detail. So these are the holdings in my portfolio, guys. I'll go through them one by one very quickly. So I do have basically what I like to call my feeders or my greatest hits. So I have 5,000 in each of these ones. I already have these ones in my regular account. So it's really, I would say, my favorite ones in terms of really nice and high income. So you have HHL, which focuses on healthcare. My favorite income fund of all time, Canoe EIT, of course, is there. One of my favorite split funds, GDV, I included it in here because it's very diversified and I feel it's one of the safest split funds of all time. Very, very nice 10 or 11% yield, very easy to get. ENS, of course, is here, another split fund which focuses on Enbridge, which I think is a great long-term play. ZWK, I was fortunate enough to get in at a really good time during the COVID crash. That's why you could see I'm up 30% on it. And you also have Inc.UN, which focuses on financials, which I'm up very much up on this one, 43%. Like I said, same deal with ZWK. I got it at a good time during the COVID crash last year. So now these are the main funds in my portfolio, and like I mentioned before, this my RRSP portfolio is focused on US listed stocks just because of the advantage that the RRSP has, where there is no 15% withholding tax on the dividends you get. So most of them are from Global X, another one of my favorite covered call ETF providers. So SRET, which is called the Super Dividend REIT ETF, focuses on 30 of the most highest yielding REITs on the planet. A really, really nice concept. So I have 10,000 here. I have 10,000 in ALTY, which is a super dividend alternatives ETF. So very interesting fund that focuses on alternative asset classes. So basically anything that is not equity. So a very heavy on the real estate here, and there's some private funds in here, some MLPs, really some rare stuff that is very hard to get access to. The only downside with this one is that it has a very high management fee, but the dividends are really, really nice, very consistent. So these two, SRED and ALTY, give about 8% yield. Then you have RYLD, which is QYLD's little brother. So QYLD and RYLD make up a nice chunk here, 15,000, 20,000 each. They're both covered call index style ETFs. Very, very, very high income. We're talking about 10 to 11% here. Really good. Then you have the global, also from Global X, SDIV. So it's a super dividend ETF. Really unique concept. I like it because it basically invests in 100 of the highest yielding dividend stocks globally. Really, really nice concept here. Very nice consistency with the dividend. They're all monthly. So the SDIV, SRET, and ALTY, the dividends have been reduced a little bit throughout the last couple of months during COVID, but you know, these are really buy and hold investments, so that doesn't really bother me that much. You just got to hold on to it, guys. CLM. So I have some of this in my main fund, but CLM is basically what I like to call the American brother of Canoe EIT. So it's a very high yielding income fund. I'm up nice on it because I've been buying some shares in the last couple of months. So I have 20,000 invested in here. Very, very high dividend yield. They have a unique dividend policy where they reset it every quarter to 21% of whatever the NAV is. So if you're going to invest in CLM, and I could feel the criticism coming, don't focus on the share price because that's really not the strong point. This is a pure income play, guys. It's not a growth play, so you can't expect anything much from a share price appreciation. This one, you're really getting your money with the dividends. And Brookfield Real Assets is a very recent fund that I discovered. It's actually the biggest part of my RRSP portfolio at 16%. I don't have this one in my main fund. I really, really, really like this fund. It's called Real Assets. So like Brookfield usually deals with, it's going to be real estate and infrastructure. I mean, that's what they're specialized in. There's a lot of corporate credit in this one. Really nice dividend yield. I mean, it's giving a 12.5% now. And this one focuses heavily on real estate, like I said. So this is definitely one of my go-to stocks when it comes to my RRSP. So as you could see, like I mentioned earlier, it focuses a lot on US listed stocks like these guys here, because there is no 15% tax on withholding tax on the dividend. So might as well take advantage of that and leave them in the RRSP. So I don't have the drip turned on. So basically every month or two, I'll take whatever the cash is in my account and I'll reinvest it manually into, you know, whatever I'm feeling. But like I mentioned, the US listed funds are really going to be my main, where I allocate most of my money going forward. So you saw my RRSP account directly, my broker account, but here it is on a spreadsheet, guys, just because I want to show you the average yield. So if you add all the yields up, the average yield that I'm making on a book cost of $148,000 is about 10.97% right now, which is really, really incredible. I have a personal goal of always trying to keep my RRSP dividend yield above 10%. It's just a little goal I made for myself. I figure it's the RRSP. You're not going to be touching the income anyway. Might as well go for the highest income fund. So that's my logic behind it. So right now it's making about $13.55 a month in dividends. So like I said, I don't have the drips turned on because a lot of these of the US listed funds don't have the drip. I know QYLD does for TD, but for some reason they don't have the drip for anything else. So I manually reinvested every month or two. Not really a big deal. But like I said, I will be focusing on the US listed stocks for my RRSP account.
For my RSP account, I'll review all of my investments in detail, which are all drip eligible. So I'll show you exactly how the drips work. Let's check it out. I have 8 ETFs in my account. This is a really balanced, safe, and diversified portfolio, simple and straightforward. These funds are focused on income, not growth. One thing to note is that growth doesn't only happen from stock appreciation. You can achieve growth via income just as easily because the income generated does grow as it's being automatically reinvested every month via the drip, causing a compounding interest effect. So ZWC, ZWS, ZWE, and ZWG from BMO are some of my favorite dividend ETFs. Adrian likes to call them baseline or foundation ETFs because they are already diversified in terms of sector, and each one focuses on a different part of the world. ZWC is Canada, ZWS US, ZWE Europe, ZWG all over the world with an emphasis on the US. HEG was added to get more exposure in international markets, so markets outside of Canada and the US. It has exposure to Europe, but also harder to reach places like Japan, Australia, and India. ZWU is there because it's a defensive nature. It's utilities and telecom stocks, the two safest stock market sectors because they focus on essential services. Everybody needs their voice and data services and electricity. It's so defensive that BMO classified the risk rating on the ETF as low to medium. That just proves my point. IDR is where I get my real estate exposure, another defensive sector, which is always great to have as there's barely any real estate exposure in the other funds. IDR is my favorite real estate ETF by far. It's managed well and focused primarily on industrial and residential real estate, the two safest real estate sectors out there. QYLD is here because A, there is no 15% withholding tax on US listed stocks in an RRSP. B, this is a huge income earner with low risk because it tracks the NASDAQ 100 index, which is mostly technology companies. Technology companies have really been the big winners in 2020. They are still considered a growth play and they should actually be considered more and more like essential services. Technology will continue to be a very important part of our society, and QYLD is a great option to get huge income from top NASDAQ companies like Apple, Microsoft, Google, Facebook, Amazon, etc. Since it's an index style ETF, you're always sure to have the best of the best when it comes to the technology. Another great aspect of QYLD is that there are no financial stocks, which tends to be more volatile in bad economic times. Okay, switching to my activity tabs, I'll show you how the drips work. As you can see, I received all the BMO ETF drips for February. So for the ZWC ETF, the dividend amount I received is $105.49, and the drip buys 6 shares worth $98.79 total. Because the drip doesn't buy fractional shares, I'll get the rest in cash. So for ZWS, the dividend amount I received is $51.87, and the drip buys 2 shares worth $38.36 total, and the rest given in cash, and so on and so forth. So going back to ZWC, for example, prior to February's dividend, I had 959 shares. Then the drip automatically bought 6 additional shares. So switching to my holdings, you can see here that now I have 965 shares of ZWC. So next month, my monthly dividend amount will be larger because of the drips automatically rebuying more shares, and so on and so forth for like 30 years. This is how the compound interest effect works.
So that's Erica's RRSP account, guys. She showed you directly in the broker, but here it is in a spreadsheet. As you could see, it's the same funds that she went over. So I just to show you really the average dividend yield. So on a book cost of almost 95,000, she's making approximately an 8.44% dividend yield, which is giving her on $95,000 a monthly income or a dividend income of $665 every month. But keep in mind that this number, right, the 665 goes up every month because of that compounding interest effect. So it is a lot lower than my dividend yield, but that's because she went with the more safer, the more balanced funds, QYLD being the one that gives her the highest yield at 11.19%. But hey, 8.44% a year is still very, very high if you ask me, right? So there you have it, guys. Those are our 2 RRSP accounts. Combined, these 2 accounts are generating a little over $2,000 a month in passive income right now. But that amount is slowly going up with time, right? That's because of the compound interest effect.
So let's say you want to know how much you will have by 65 years old. You can calculate that now using the compound interest calculator. You can find that tool in our website. The link is in the description below.
Yeah, so let's check it out together and see how much our accounts are projected to be worth 30 years from now, thanks to the miracle of compound interest. All right, so here's the fun part, guys. Let's use the compound interest calculator to actually calculate how much my RSP and how much Erica's RSP will be worth when we turn 65. So in the initial investment, always put your book cost, not what your actual value is right now. So I know mine is, I have a $10,000 gain, but you don't put that. You always put the book cost, how much money you're contributing to your RSP. So right now, at the very minimum, and we're planning to do this until we're 65, to at least contribute $250 a month. So for the interest rate, I know I had almost 11%, but I'll put 10% just to be conservative. 30 years to grow, right? I'm 35, so 30 years I'll be 65. So how much will my RSP be worth at 65? Well, the answer is $3.5 million. Pretty incredible, right? For Erica's situation, the initial investment, so the book cost, we'll put $95,000. Same thing, we're contributing $250 a month. We'll put an interest rate at 8%, even though she's making a little bit higher. And the interest, of course, is compounded monthly. Years to grow, 27 years. How much will her RSP account be worth? Approximately $1.1 million. So combine those two amounts and you have exactly what we put in the title of the video. So you could see that we weren't lying, approximately $4.6 million. Pretty incredible, right, guys? This just shows you the power of compounding interest. So I hope that for all of you watching that don't yet have an RSP account or you don't manage it yourself, that you seriously consider taking it into your own hands.
Building an RRSP account is important and can be completely hands-off and easy thanks to the drips. Of course, that's always optional. So what strategy do you guys use for your RRSP? Drop us a comment below and let us know.
So please visit our website, guys, passiveincomeinvesting.ca, to access our digital product that we're very proud of, the Ultimate Dividend Passive Income Investing Package, which includes a huge list of ETFs, split funds, income funds, high yielding single stocks and REITs, along with my personal comments for each one. It's really all you need to build your own income portfolio. It's only at $25, but it might go up soon, to make sure you pick it up.
Also, keep in mind, if you do purchase the product and we do come up with a new version of it, you will receive that new version for free via email.
There are also free tools as well on our website, free tools that will help you on your investing journey, like the budget tracker, a blank copy of my portfolio, so you could use it as a template to track your own investments. And of course, you could also book a one-on-one video call with me if ever you want me to review your existing portfolio, help you build a new portfolio, whatever your needs are. I'll do my best to help you and answer all your questions. I've done dozens of sessions and most of them seem to be very, very helpful for you. And honestly, I just love doing it. And as always, please support us and this channel by hitting that like button. It's free for you and it helps the channel out, so it's a win-win. And finally, make sure you're subscribed so you don't miss out on our future content and community posts on passive income investing, which is really all designed to help you on your investing journey. We're also on Instagram, so if you use it, follow us there as well. Our mission remains the same, guys. It's to help everyday working Canadians to invest on their own in order to build a stream of passive income to enhance their quality of life. So with that, take care, guys. Stay safe and see you next time.